Valens Research, Uniform Financial Analytics.
JD.com, for those of you who don't know, is a Chinese retailer. And JD, what we see, which is incredibly powerful, firstly, what we see here is as reported ROA for JD is -1%. JD isn't losing money. JD actually has an 18% return, and it becomes even more apparent when we look at the as reported versus uniform PE. Right? On an as reported PE basis, JD actually went from making money in 2017 to losing money in 2018. JD saw returns. JD didn't just see returns be negative. JD went from making money to losing money. In reality, that could not be further from the truth. JD actually went from making $4.90 to $5.90, and his forecast for ROA is to rise to $11 a share this year in 2019. As reported metrics would make you think that JD is hemorrhaging money when literally it could not be further from the truth. And because as reported metrics misrepresent how profitable JD is, investors misunderstand how profitable JD is. By the way, just for context, because it's an obvious question, why is it the market's getting everything so wrong for JD? Well, there's a couple different reasons. One, JD's investing in R&D. They're investing in the future of the business, and the market is punishing them for that. As reported accounting is punishing them for that, expensing all of that R&D when most of that's an investment. Also, JD pays stock options, right? They compensate their management in stock. Well, guess what? That's a non-cash charge that has nothing to do with the operations of a business, but has to do with mark-to-market accounting for the financial aspect of how a company finances itself. And also the company has amortization from their acquisitions. Those things cause as reported net income and ROA to be negative when actually they're phenomenally positive. This company is throwing off 9 billion Chinese yuan in earnings. It is not a negative ROA business. It is producing an almost 20% return. But because analysts don't understand that because they're looking at as reported metrics, their pricing JD to C returns actually drop dramatically, because they think that they're pricing JD to just finally see an inflection in its profitability, when in actuality they're pricing this company to see returns break down. Now let's just look and see, what if we actually thought that JD could grow at 25% a year going forward, but that returns, like Amazon or anybody else, could actually stay at around 20%. What would JD be worth? Actually, let's just change this to 30%. If we gave that scenario for JD, JD would be worth 1,000% higher than it is today. Hell, I could say that JD is never going to grow again. And if I said JD was never going to grow again, but returns were just going to plateau at what I already know the profitability of this business is, JD would be worth 350% more than it is today.
Valens Research, the world's leading source for uniform financial analytics.